Welcome to the Business Finance Bulletin, episode 89. Hi, this is Warlow from Business Loan Services and welcome to my Friday Business Finance Bulletin, my weekly roundup of news, tips, ideas and strategies on raising finance and dealing with banks. So what have I got for you this week? Well, I'm going to be looking at an alternative loan provider who's now been around for 10 years and is now starting to branch out across the UK. Also be looking at a report from the Institute of Directors about why both investors and business owners should be doing more around the special schemes when it comes to investing in and raising equity. And also some news on support from one of the big 5 accountancy firms that it's giving to business owners who are looking to raise money through crowdfunding. And in my business finance tip of the week, the difference between profit and cash. So let's start off by a new lender that's caught my eye. Now, it's not necessarily a new lender, it's new to me, but the business has actually been around since April 2005. So just celebrating its 10th anniversary. So what is it? Well, to be honest with you, the name of this lender really encapsulates the ethos of the business for me. It's called Fair Business Loans. Now, when the business was established, say in 2005, it was very much focused on the East End of London. And the whole raison d'etre of the business was to provide ethical loans to individuals and businesses at a fair rate to avoid them having to go to loan sharks. Well, the business has really expanded, and the reason it caught my eye was that they are now starting to lend to businesses across the UK. So how does it work? Well, the first thing that is really is a great thing is they've got human beings looking at your request. Yes, there's an online application to go through, but an individual actually sits down and goes through your application. And that means you have an opportunity to tell your story. So what about the eligibility criteria? Well, the loan amount starts from £2,000 up to a maximum of £20,000. The repayment term, 3 months up to 36 months, so good short-term facility. The interest rate, 2.3% fixed per month, so akin to credit card rates. And for your business, you've got to be turning over a minimum of £50,000 per year and having been trading for 2 years or more. So if you've got a short-term cash requirement or an asset that needs buying that you can pay back within 3 years, then check these guys out. A quick process, they give you an answer within 5 working days, so quite a good quick turnaround. So if you want to know more, just simply go along to their website, fairbusinessloans.org.uk. So let's move on now from debt financing to another source of funds, mainly selling shares in your business, selling equity in return for cash. Now, there have been 2 schemes around for many years that were designed to encourage businesses to sell equity to raise funds and also to encourage private investors to take advantage of the opportunity. And those 2 schemes are the Enterprise Investment Scheme and also the Seed Enterprise Investment Scheme. But the results have been a bit mixed, and this really came out in a report that's just been released by the Institute of Directors. And what they found out was that in 2013-14, they estimate that about £1.6 billion has been raised through these 2 schemes. But, and here's the issue, they say, 95% of the money raised came from large investors. Only 5% came from smaller private investors. Despite, and the reason the schemes came into play, despite there being significant tax advantages and tax benefits that go with it. Secondly, the Institute of Directors also found out that awareness amongst businesses about the schemes are quite low as well. And bearing in mind that its membership base are really directors of businesses, they found out of those surveyed, only 38% of them are really aware of the scheme. So a big awareness gap. The other thing, also they found geographically, most of the money, in fact nearly 70% of the money raised is coming from businesses based in London and the South East. The rest of the country really aren't taking advantage. So, what does the Institute of Directors want the government to do? Well, first of all, to encourage private investors, it wants the government to make sure that these funds can go into ISAs. In other words, you can invest through the schemes via ISAs. They also want the government to do more work amongst business owners to raise awareness. They want a pilot scheme to be launched in the North East to really get businesses up there to utilise the scheme. And they'd also like a fund put in place so private individuals could just invest in a big umbrella fund as opposed to picking out individual investments. So some great ideas there. Now, if you want to know exactly what the EIS and the SEIS scheme is all about, whether you're a business owner or an investor, go to the government's main information portal, which is gov.uk, and then in the search box, just type in EIS or SEIS, and then you'll be taken to a page where you can find out a lot more information about those two schemes. So let's stick with crowdfunding for a moment, and another example caught my eye this week of collaboration between mature, well-established businesses and the more entrepreneurial, new world crowdfunding sites. Now, the crowdfunding site in question is Epsd. Now, Epsd started in June 2015, and rather unusually, they offer both types of traditional crowdfunding services. Namely, if you want to raise equity, you can do that through that platform, or if you want debt, you can also do it through them as well. So, where's this collaboration come in? Well, KPMG, one of the UK's largest accountancy practices, has teamed up with Epsd to provide support to businesses looking to raise money through Epsd's platform. So why would that be? Well, they've realised that, particularly on the equity side, it can be quite a bit daunting for businesses putting everything together and putting the right pitch together. So KPMG are coming in now to offer advice and support. So not only is that great for the businesses, it's also good for investors as well, because it means that they get a little bit more comfort and support about the type of businesses that are looking for money on the platform. So it's a great example there to say old world meeting new world. If you want to know more about what Epsd can do, you can go along and visit their website, investden.com. Moving back to the more traditional world, invoice discounting. A new add-on service has jumped out at me this week from Close Brothers. Now, Close Brothers are an asset finance provider, but also invoice discounting and factoring. And it's on the invoice discounting side that they've added another arm to their offering. Invoice discounting, you've got money tied up in debtors for 90 days, but you can't afford to wait 90 days. You need the money now. And that's where the likes of Close Brothers will come in and advance you traditionally anything up to 80 to 85% of the face value of that invoice, and you get the remainder when the invoice is paid. But hey, sometimes 80 to 85% just doesn't cut it. You really need all of that cash in order to fund the next sale. So Close Brothers have listened to their customers, and they've now come up with an additional add-on called Liquidity Plus, where in some circumstances you can now get a top-up taking the advance up to 100% of that invoice. So that's a great service there. So if you want to know more, just go along to the Close Brothers website, or just find out your local Close Brothers representative, of which there are many across the UK. So let's move on to my business finance tip of the week. And in this week, a clip from a seminar that I did where I want to share with you the difference between profit and cash and why it's so important from a bank's perspective. Let's go to that clip now. Two key questions that any bank is going to ask, and that you should ask as well. And this is the key one. Can your business generate sufficient cash in order to pay back? And cash is the key word here, and we're going to look at cash flow later to give you an insight into how businesses can manage cash flows better. But at the end of the day, it's down to cash. You may be a profitable business on paper, but that doesn't actually translate sometimes into hard cash. Sometimes you can get the accounts from your accountant at the year end, and you're not particularly interested in opening that big brown envelope because you know what's in there, and which is the bill from the accountant, hidden in amongst the annual accounts. You pull the accounts off and you have a little look and say, oh, great, it says I made a profit of £30,000 last year. How come I don't feel as if I've made £30,000 this year? Yeah, because it's all trapped in assets, trapped in debtors, trapped in stock, trapped in all the bits of bobs that you bought, etc. So you can be a profitable business on paper, but it doesn't actually translate at the end of the day necessarily to cash. And that's where the bank is going to look. Can you generate the cash flow in order to pay back? So there we are. Remember, profit does not equal cash. It's all about your ability to pay your loan repayment when it's due. Profit doesn't do that, but cash does. So that's it for this week. As ever, I hope you enjoyed the ideas and tips I had to share with you. If you did enjoy it, please feel free to share it amongst your friends and colleagues. So that's it for this week. And don't forget, you can get lots more on the podcast version of this and other podcasts via our SoundCloud page and also our iTunes channel. All you have to do on both those platforms is type in Business Finance Bulletin. So that's it for this week. Thanks very much for being with me. I hope you enjoyed it, and I look forward to being with you again next Friday. Have a successful and profitable week. Bye-bye now.